Welcome to Talking Tuesdays. I am your host, Fancy Quant, and today I'd like to welcome Jeff Rosenberg. Jeff is a managing director at BlackRock. He is the co-lead of systematic fixed income active long-only products, including mutual funds, institutional portfolios, and ETFs. Prior to joining BlackRock, Jeff spent nearly 10 years at Bank of America Merrill Lynch as the chief credit strategist, coordinating strategies across all fixed income, securitized assets, credit, FX, and commodities. Jeff also specialized in quantitative credit modeling and developed the first commercialized credit portfolio analytics systems from a dealer firm. Jeff, welcome to the channel.
Thanks, Dimitri. Great to be here with you.
Awesome. So how did you get into this process? Like when you were growing up in high school, did you think to yourself, like, I want to be in wealth management or asset management or finance? Or like, did you have some sort of idea of where you were heading? Or was this kind of something you learned across time with school and education?
No. When I was, in high school, I had no idea what this world was, or, it was really, I'm old enough where it kind of predated. And even if it was out there, I wasn't going to be watching the daytime market television of CNBC. I discovered financial markets kind of like my first year introductory class to economics, I think is when it was. I didn't really know what I wanted to do, but I had some interest in business. I really had interest, Dimitri, I had interest in getting a job out of school. That was my interest. I had a very practical father. He was an accountant. He studied accounting, and he was like, you should do accounting. Accountants get jobs after school. And I was kind of like, okay, maybe I'll do that. And, sort of went down the track of going into the business school. And then once I was in the business school, got really much more interested in financial markets. And that sort of began the journey.
Okay. You have listed, you went to school at University of Wisconsin and University of Minnesota studying math and business. Did you do 2 degrees or did you start one and then transition with that process?
Yeah, this is like every interview question I got coming out of undergrad, because I had a very unique resume, because I have 2 undergrad degrees, and I'll explain that really quickly. So I went to University of Wisconsin, Madison. Super psyched. My son is a senior, just got into Wisconsin last night, so we're having this whole conversation. I'm very excited for him. But I went to Wisconsin, did my 4-year undergrad, did undergrad business degree, and I met a really important person in my life who became my senior honors thesis advisor, and he guided me through the process. But he was important because I took his Intro to Finance class, and I was a decent math student. I did well in math. I took AP Calculus, tested out of all my math requirements, and never really had much more interest in it from that point on, and then just, took other classes. And he really showed me how you can use mathematics in finance and why it matters. And that totally opened up a world of intellectual curiosity that then went into a pursuit of a PhD program. And I remember sitting in his office and I said, I think I really want to keep going on this. And he said, great, drop out of the business school, go get a math degree. And I said to him, I got loans to pay off. I got to go get a job after school. I can't go right into the PhD track. He's like, fine, keep in touch, but you should, I'll give you the courses that you should take, and you should start taking them. And so when I was working, and I started in finance in an asset management company in Minneapolis, Piper Capital Management, and at the same time, I was taking math classes at night to sort of pursue this longer run goal of eventually going back to school for a PhD. And I'm at the University of Minnesota, and I'm taking all these classes over the course of 2 years. And the advisor said, if you take one more course, this like topology course or something that wasn't on my list for, prep for finance econ PhD, they said, we'll give you a degree because we recognize all the undergrad courses, reciprocity. And so I took that course and I got an undergrad degree in math in pursuit of pursuing a PhD program.
Awesome. And so then did you work for a while and then decide to go back for a master's at Carnegie Mellon, or like how is that transition? You have a unique background going from business, math, and then making that transition into the quant space?
So I worked for a while, and I worked at a very critical juncture when we talk about financial history. I worked through what I call the original mortgage market crisis. That was the mortgage market meltdown of February that was kicked off in February of 1994. So I joined Piper Capital as a summer intern in the summer of 1990 and basically watched the fixed income markets, the development. This was kind of the era of Liar's Poker and Louis Ranieri and the developments of mortgage, agency mortgages and CMOs. And that was like the derivatives of the world that I was exposed to. It was also the period of bankers' trust and the development of broader financial derivatives, and later would become a place that I spent some time, bankers' trust, and then went through that whole derivative history. But the most successful application of mathematics into finance at that time was Black-Scholes Merton and the application of that stochastic calculus and derivative pricing technology was really my fascination. And that's where as I was applying to PhD programs, I was also looking at master's programs, decided the master's program was going to be the better route for me, and went to what was then really a brand new idea in what Carnegie Mellon calls computational finance, which they're always off-brand. They called their MBA an MSIA. Now everybody kind of calls it financial engineering, and it was one of the first, if not the first, financial engineering program. Courant and Chicago call theirs mathematical finance. Some programs are more out of the math program. Some are more out of the stats or the business school. Carnegie's was an interesting program because it was all for schools, but it really was centered around this particular moment in time, which was the late 80s development of quants and PhDs coming to Wall Street, sort of heralded by the Goldman Sachs, Fisher Black and
Bob Letterman.
The other head of that group, that late 80s revolution in the first generation of quants coming to Wall Street. And a lot of it was in this derivative space and the derivative pricing technology. And if you had the technology, you were the leading light of that era. And the technology that was necessary, because this was kind of pre-compute. This was pre the ability to do things with Monte Carlo simulation and what people would call somewhat derisively, the math people would call somewhat derisively, brute force. You actually needed to do it with the understanding of the mathematics. And the mathematic people were really in charge. And then the computer science people just took over because the capability of doing things through simulation kind of rendered a lot of the necessity of the mathematics less important. I think it's still a really important foundation, and I'm really happy that I was grounded in that foundation. At one point, I could sit down, and that was the whole goal. Like, okay, derive Black-Scholes from first principles, and that was kind of cool. You just couldn't get paid, and you couldn't get hired to do that because everybody had kind of taken that and commoditized it, even by the mid to late 90s.
Yeah. Do you think we have, I guess, maybe fallen away too much? I feel like nowadays it seems like we rely a lot on data and computer science. And there seems to be a falling away from like traditional like the theory and the math portions of it. Do you think it's kind of evolved with that, or do you think kind of, I guess, Black-Scholes still have foundational principles, stochastic calculus, even things like topology and other kind of obscure math topics, linear algebra, which is used every day in a lot of the computations. Do you think we're falling, I guess, too far away from the theory and the math and more on the computer science side, or kind of how has that evolved across time?
So it's interesting, and it's interesting, as I mentioned, my son, and I have another son who's a junior in college. So you're looking at it now as like, okay, what is the right educational background and what's required? And you look at the coding assistants and the things you can do today that, like, you don't necessarily need to know all the kind of foundational aspects of computer science that I spent a lot of time learning. However, I think that it's still really, really important to know these things, that just using the tools without really fully understanding them puts you at a disadvantage to someone who has a deeper foundation. And the point of kind of primary and secondary education is to build that foundation. So we were talking beforehand, my wife and I were talking this morning about like, okay, well, my wife's from medical profession. So, she's like, why do you need calculus? And and it's kind of a question many parents and maybe many kids, and I'm like, the foundation of everything we do is mathematics, the use of mathematical tools. Now, calculus is like foundational in bonds because bond math is a calculus problem. But you look at some of the other more modern stuff that we're doing, and it's linear algebra and it's matrix algebra, and like understanding how that matrix math works is really important. Now, do you need to understand it to like use the tools? No, but is it helpful if you want a deeper understanding? I think so, and I think that's really, if you're interested in those kinds of fields, then you want to be building those kinds of foundations because you need the foundation to build upon it in undergrad and later grad school, the kind of techniques and the understanding around those techniques. And so it starts with that high school math program.
Yeah, definitely. I think math is a critical foundation. So I started as a finance undergrad. Big mistake, and realized I needed to go into quantitative finance because Wall Street had changed. It wasn't like it used to be. And I had that learning process of needing to catch up on all those fundamentals just to really understand the problems themselves and how you come up with better solutions for it. Do you want to talk a little bit about, so you went through this grad school, working into the fixed income markets. How did you progress through that career, through all the fixed income up to today, to more of like your current role here? Have you always covered just a specific market like mortgages, or have you kind of bounced around between different products?
Oh, no, I've bounced quite around. So like when I started in the 90s at Piper Capital, I actually started in adjustable rate mortgages. It was a steep yield curve environment, and people got more affordable mortgages by taking on the interest rate risk. By the way, that past is going to come to a future, to you soon, right? We're re-steepening the curve, and so how do you get affordability back? We went through that whole era in the last precursors to the GFC around affordability products, but you can also do it through shifting the burden around interest rates. And there's some policy things that could be very interesting around there as well that you could bring to bear to try to shift where some of that risk lies. And so it'll be very interesting. But it's funny to talk about that 30 years later, coming back to some of those very first things that I started working on. But that was in mortgages, and then I spent some time at Bankers Trust in derivatives, and then the real kind of like crux of my career was shifting into quantitative credit, and that was the move into sell-side credit research. I was hired by kind of a quant-oriented strategist who was interested in bringing kind of like what we had done in an earlier generation for mortgages to credit. And at that time, credit was just not the purview of quantitative people. He used to have this joke with me, like if you could read and write, then you went into equities or credit analysis. You did like balance sheets. And I even had an interview coming out of grad school on Wall Street with kind of a not a very nice person. And they said, you have all this math on. Let me tell you about the math that we need in this business. You need to know how to add and subtract. That's all the math that you need here. Well, that was, somebody who was like just, tearing up balance sheets and doing fundamental analysis, and that's fine. And they didn't have a very, positive relationship with mathematics. And so the joke was, if you could read and write, and you couldn't add and subtract, like those people went to credit or equities, and people who could add and subtract, they went to mortgages. That was the quantitative field. So what we did is we brought quantitative tools and techniques to a very non-quantitative audience. I spent years basically teaching the credit universe in my perch as the chief credit strategist about quantitative techniques. And it was at the time, kind of late 90s, pre-GFC, where you had this huge growth in the credit derivatives market. And the growth in the credit derivatives market kind of really jump-started quantitative credit techniques. And around this time, there was one other person doing quantitative credit, and that person turns out to be my current boss here at BlackRock, Tom Parker, and he was at BGI. And that professor that I was mentioning who was guiding me earlier, well, he was actually Tom's boss at that time. So it was kind of like this weird, coming back together of a bunch of ideas and people and quants. And I had written this paper, this sell-side paper, which was basically just applying what I had learned on Merton models. But the 77 paper, the value of the firm as an option application, which is really the foundation of what was at then the only kind of quant credit operator in the space, which was an outfit called KMV, which was subsequently bought by Moody's. And they were doing quant credit analysis for bank loan portfolio managers. And so we were sitting in a seat of publicly traded credit. It was kind of pre-CDS. And we said, we can do this in public bonds. And so I rolled out a model, which I called the CUSP model. I was at Credit Suisse at this time, credit underlying securities pricing. And we did a whole bunch of quant analytics, and just no one had seen that stuff before applied to public bonds. And then we rolled it out to CDS. And then I moved over to Bank of America Securities and we rebuilt it. And then you had this flourishing of the whole quantitative credit portfolio business around tranches and tranche products. And so we built basically an entire quantitative portfolio risk management, risk analysis system over the course of those years. And then the GFC came and it all kind of blew up. And I looked for, some exit. I had built over this time a really good relationship with Rick Reeder over his transition. And that actually got me to BlackRock, where I reconnected with my friends in BlackRock Systematic. And then about 8, 9, 10 years ago, moved from kind of the fundamental side, having had worked for Rick, and then spent some time at the BlackRock Investment Institute, and then moved over into Systematic, which is kind of a return for me back home. Long story short.
Yeah. So why don't you explain what that is? What does a portfolio manager on the systematic side do? I know a lot of people have like this very marketing-y, like Wall Street-y kind of idea of what a portfolio manager is. But do you want to talk a little bit about what a portfolio manager is and why being in the systematic side is different than the discretionary fundamental side?
Yeah, especially since I, sat in the discretionary fundamental side and started my career, earlier in the 90s, as I mentioned, with discretionary portfolio managers. So what does a traditional discretionary portfolio manager do? Whether they're fixed income or equities, they are sort of at the top of the pyramid of decision-making around portfolio construction, to making decisions about what investments go into the portfolio, what investments don't, how much risk is taken, and ultimately having that final say on portfolio investment decisions. It's a great job. It's super exciting. You analyze markets, you take risk, you have responsibility for returns, you're running a business. It has all those aspects. And in a traditional sense, it's sort of described as like a pyramidal structure where the PM is kind of on top and then all the support functions are rolling into that role. In systematic, it's different. And what makes it different is how are decisions being made in portfolios, right? So there's a spectrum of investment styles, and let's sort of make it kind of the extremes. You have full discretionary, that's the model that I just described, and then you have kind of full model, full black box driven, where the model is making all the decisions. So you think about some of the stories that come out of Renaissance and the types of people that they hired, they would never have hired people like you and I. It's like, oh no, too much noise added to the system with people like you. So no, thank you. So there's varying degrees, but really, I think there's kind of a bright line in between in this spectrum, and it's really about the primacy of decision making, and so where in that spectrum are decisions made? So if you're fundamental and discretionary, ultimately the decisions are being made by the people. And if you're systematic, then ultimately the decision is being made by the process and the model. And that's really the difference. So people talk a lot about quantamental, and that's confusing because it's in the middle. It's in the middle, but it's to the left side. It's to the discretionary side because it's models kind of helping portfolio managers make decisions. But notice the predicate there is it's the models helping portfolio managers make decisions. So in systematic, it's the portfolio managers that help the models make decisions. And what do I mean by that? So the job of a systematic portfolio manager is to work in partnership with researchers. So now the pyramid kind of gets flipped upside down, right? And so at the top of the pyramid is this sharing of responsibility between research, model development, and portfolio management, less in a hierarchical sense and more in kind of a lateral sense, where the goal is to make better systems for delivering repeatable, durable alpha. That's sort of the key. And the insight of systematic investors, I want to get into a little bit more in detail, particularly around the legacy and the history of BlackRock Systematic, because it occupies a very important part on the systematic, sort of tree of systematic life. I sort of describe it because systematic really encompasses lots of different investment styles and histories and philosophies. But the intellectual roots at BlackRock Systematic come from Richard Grenold and Ron Kahn. Ron Kahn is the head of our research, and their seminal work in active portfolio management, which basically sort of lays out how would you structure an investment process if you had some piece of information that was valuable. That's sort of like the basic framing of how a systematic portfolio does active management. And so the role of the portfolio management within that philosophy is very different than in a discretionary one. And I want to go into that in a little more detail. But that's at the high level, it's really around the primacy of decision making. And now let's just unpack that a little bit about why systematic investors are different and really how their portfolios look different as a result of this philosophy. So, like, one of the critical sort of insights in Grenold Kahn is about the relationship and the source of alpha. And really the measurement of alpha in the portfolio context of alpha relative to the risk that you're taking in the portfolio, right? So it's not absolute alpha, it's risk-adjusted alpha, right? So we want to look at what we call, the industry calls information ratio. And what is the source of that information ratio in a portfolio? And we can relate that kind of structure to this question of what distinguishes a discretionary portfolio manager from a systematic portfolio manager. Okay, so in this kind of observation, we'll look at the idea of skill, investment skill, sort of a simple concept, right? But like good quants, we're going to have an operational definition for what skill means. And so what skill means, it means what is the correlation of my information to future returns. Very simple kind of concept, right? And so we can think of that and we can kind of relate that concept of does my information translate into future returns into a somewhat easier concept to understand, which is, well, how good is that information at translating into future returns? And when I say future returns, what I mean is like future idiosyncratic returns, not future beta returns, like is the market going up or going down, but am I able to identify idiosyncratic risk? That's really the source of alpha. And here's the key insight. So if we relate it to kind of frequency, and we ask the question, what is an investor look like that has no skill? Well, in a frequency sense, it says their active management decisions are basically random noise. 50% of the time they're successful, 50% of the time they're not successful. So we would label that type of manager, discretionary, fundamental, systematic, doesn't matter, they don't have any skill. So what does skill look like? It looks like the frequency of your active decisions is greater than random chance.
Okay.
Now, so here's kind of the key question. What do systematic investors assess of themselves their skill to be relative to what do fundamental discretionary investors think of their skill to be. So let's take the greatest fundamental investor of all time. Who's that, Dimitri?
Warren Buffett. Yeah.
So what do we think Warren Buffett's skill in terms of like the frequency with which his active management decisions resulted in a positive return is in terms of frequency? Now I'm asking the questions.
It's definitely more than 50%. But
yeah.
Again, I don't think it's very high. I don't think it's a large percentage of accuracy. Probably maybe 60%, right? And 40% wrong.
So people have like studied Buffett, and he's like just outsized. And part of the reason why he's outsized is that he could kind of change the rules of the game and liquidity and other things. He's not a price taker. He's kind of a price maker when he makes his investments, but he's like over 75%. Okay. So when fundamental investors sort of aspire, fundamental discretionary aspires, that's the gold standard to which you aspire. And so if you kind of ask most fundamental investors, what is your skill? They're going to think the skill is like 70, 75%. Maybe if they're more humble, it might be 60, 65%. Then we can actually test this. We can actually take publicly available data from active managed mutual funds, and we can see what are the holdings, what are the results, and academics have done this. And the result is, what do you think the result is? Like top decile managers in active equity portfolios.
I know it's low. I've seen some, it's got to be like maybe 53, 54%.
Exactly. So it's low, but not only is it low, it's like kind of shockingly, surprisingly low. And this is like the great insight of systematic investing, which is to basically admit like active management is hard. Like it's really hard to have skill. And so what is the mathematical sort of result if you realize that skill is really hard? What do you want to do if like your ability to be right is only like 53, 54% of the time?
I mean, it'd be trying to figure out which decisions are better ones and then weight those a little bit heavier. And then when uncertainty is high, is reducing position size.
Yep. So all those are good answers. And the other answer is you want to apply that skill as many independent times as possible.
Yeah, makes sense. Yeah.
And so like the really, like I have this conversation with my kids a little bit. They're kind of interested. What do you do? And like, how do you think about it? We'll have this whole conversation. And so the analogy to think about, and it's also a little bit like kids are super exposed to online gambling and sports books. And I just try to explain to them like the casinos aren't built on winners. Casinos are built on losers. And why? Why is it that casinos are built this way? And it's this exact same math, right? Because the roulette wheel has a very tiny odds of winning for the casino, right? And if you spin that roulette wheel over and over and over, which is what the casinos want you to do, just keep coming back, you are guaranteed a very, very small profit with a very small standard deviation. That's what the math kind of like takes you through. And it's a wonderful example. And so you apply it to investing and you apply it to systematic versus discretionary. And what it results in is that systematic investors recognize that skill is very hard. And as a result, breadth, and most importantly, what we call effective breadth. So knowing what is truly an independent spin of the wheel, an independent investment from what is just another highly correlated, the same investment. So if you have very high breadth, low skill investment, what do you result in? You result in very repeatable, reliable alpha generation. Okay, so that's what systematic investing does. Let's just contrast that for a second to fundamental. So back to the fundamental investor side, you can take this problem and you can say, yeah, investing is hard. And so you know what we're going to do? We are going to invest 10,000 hours into every single individual position. And we're going to raise our skill as a result of the depth at which we understand the world and the universe. And our skill isn't going to be that kind of top decile, 53, 54. It's going to be better than that. And if you truly believe that your skill is better, then what should you do with your portfolio?
Assume you'd put more weights onto you and short some other positions.
Yeah. You have a very concentrated portfolio. So if you believe your skill and your success rate is really high, then what you have is actually the opposite of systematic portfolios. You have very concentrated portfolios. And both of these strategies can be successful at the objective, which is delivering durable, repeatable alpha. But they approach that problem in a completely different manner. Right? So systematic investors are about breadth and maintaining that small edge, and depth and discretionary investors are about deepening and expanding the frequency of being correct and then concentrating that portfolio on those high conviction bets. And so when you look at, say, a long-short equity portfolio, a really good example, long-short fundamental discretionary portfolios tend to be like 10 to 20 names long, 10 to 20 names short. And each name has like a book and a story that the PM can go unbelievably deep into, like the third or fourth degree of detail, because every position is so well researched and understood in order to believe and deliver on that higher outcome. So those portfolios and that process looks very different, and the role of the PM looks very different relative to that systematic portfolio where each one has much lower conviction because the expectation, the narrowness between skill and luck is recognized to be smaller. But the objective is, how do we build those portfolios so that those bets are independent and uncorrelated, and how do we get the breadth into the portfolio? It's one way of thinking about this first question of what is the life of like a systematic PM different than a fundamental discretionary PM.
Yeah, it makes a lot of sense. How do you see AI playing into this? Because I remember in my undergrad, doing one of those reports and looking, I was valuing Nike, and I was looking at like the number of layoffs they had, and I'm digging into like the management styles, and to your point, doing a lot of depth on that. We're seeing a lot, I guess, with the LLM space here of creating, I guess, more information processed faster. I don't know if that means better or more accurate, right? There's always this debate of if it actually is functional. How do you see AI playing a different role in both the discretionary side as well as kind of the systematic side of that?
So, I mean, one way on the first thing, on the discretionary versus the systematic, is the AI on the discretionary side, they're tools for portfolio management decisions. Right? So it follows a long list and line history of quants in service of the PM as decision maker. So they will continue down that route. In systematic, it's completely different, because systematic has been, and particularly at BlackRock Systematic, we've been doing AI long before anybody knew what AI was, right? Because before ChatGPT kind of came on the scene and sort of opened our eyes to the wonders of generative AI, we had a much earlier generation of wondrous evolution, right? All the things that we've kind of discovered, voice recognition, facial recognition, all more kind of predictive, earlier versions of AI that we've been employing in our investment process, particularly on the equity side, for decades. So what is this all about? It's, again, back to that framing of maintaining that skill and maintaining that portfolio construction of independent bets. And AI features into both sides of that. It actually has a name. It's called the fundamental law of active management of how you deliver alpha. And we've been doing it for a really long time. So we can kind of talk about like the ability and use of AI and kind of the kind of earlier predictive AI that nobody really was talking about. And everybody wants to talk about the LLM and the generative side because that's more sexy. All of it is happening. But I want to just take one step back to also sort of describe another feature that's happening around the same time, right? And it's related to all of these incredible technological changes that we've been living through over the last 20 years, right? You kind of think about it like dating it with the release of the iPhone. And what that sort of unleashed, right, was this revolution of data and data availability, right? When we move the physical world onto the online world, right? And it started first with desktops, and you kind of think about Facebook, and it was all about the computer experience, and then they had to move onto the phone. All of that evolution has created as a an unintended effect, this incredible proliferation of data. And so now when we think about AI, we can think about AI as sort of a tool that can sit on top of this incredible proliferation of data, right? And so it's the combination of data and then tools for analyzing the data that opens up an entire new world of opportunities to derive skill, right? So I'm going to bring everything back to this simple framing of objective. My objective to deliver for my clients is alpha. How do I do that? I invest in skill and I invest in breadth and portfolio tools and construction. There's another piece of it, which is how do I implement my portfolios? That's a bigger part in portfolio management. The researchers are more on the skill. We're doing it in combination. But what AI and data is giving us is this proliferation of opportunity. And here's what you're seeing really kind of developing around this, which is very important and interesting, which is this data is not like the old data, right? So like the early, we just celebrated our 40th year anniversary of the founding of BlackRock Systematic. Our longest portfolio strategy that is continuously run on the equity side has been around for 40 years. And you go back and like, what did Systematic look like? It looked pretty basic. Mm-hmm. It had three signals: price to book, price to earnings, and I forget the third one. Momentum came in later. It was like a later generation. And it was really about, could you actually get all those data pieces into a spreadsheet and then optimize that in a way where you could generate portfolio holdings, in a real-time basis. Like that was kind of state of the art, right? So three signals and a little bit of portfolio technology. You fast forward to today and you look at our signal library on the equity side. It's over 1,000 1,000 signals and 50 to 100 new signals coming in and signals evolving alongside that technology. And what that does is it extracts the ability to find skill out of these new opportunities. But this is the key difference. Those earlier data sets, they're pretty structured. It was a price that was related to a security. It was a balance sheet related to quarterly financial statements. You didn't have to worry about the structure. And all of this alternative data that has grown up as we've moved the economy from the real world, bricks and mortar, to the virtual world, a lot of that data, most of that data is unstructured data. And so the challenge, and it's a huge challenge that cannot be underappreciated, how much time and investment and scale is required to successfully navigate this challenge, is how do you build the systems that are required to take in unstructured data and map it to alphas? That is a non-trivial problem. It is a very expensive problem to solve. And it's part of the reason why you see in the hedge fund space this kind of like shift in our understanding about what does success look like in the hedge fund space. So like in an earlier era, what we saw was success was small. And if you got too big, then your success would sort of drop off. And there was kind of a long-standing conversation around that. And you look at today, and what are the most successful hedge fund firms? They're multi-strat, multi-billion-dollar behemoths. And you look at where the asset flows are going, they're going to scale players. And part of the reason for that is that the success in that space, in the hedge fund, which is the most pure expression of this idea that our objective is the pursuit of alpha for our clients. That's in the most pure form. I do it in liquid alternatives, which is in ETFs and in mutual funds. That's a pure alternative. That's a pure expression as well. It's just in a more democratized wrapper. You don't need QIB and QSIP qualifications. More people can get access to it. But what that business is becoming more in this world of AI and data proliferation is you need the scale in order to take that funnel and turn it down. I often ask in like interview questions, what's the difference between data and information? Information is data that is useful.
Yeah, I was going to say, as we see this big explosion here, that's like the critical problem, I think, is the signal versus the noise.
Yeah. And how you figure that out and how you map that, especially around unstructured data, it takes a tremendous amount of scale and infrastructure. And that's why you're seeing a lot more of the ability to provide persistent alpha across cycles resting more in the scale players. And that's a big evolution around this question of AI. And now to get to LLMs, where are we going next? Well, like the first thing was like, oh, these LLMs are cool. And oh, I can get an enterprise license and do an API, and I can build a signal off of API calls to Anthropic or Gemini or Chat or OpenAI's models, and then we can fine tune those models. And the next phase, if you have the scale like we have the scale, is well, we can build those models ourselves. We can build those models specifically within the financial construct. And so if you look at what's going on in Anthropic, this is what they're doing, right? They're doing all these like verticals, right? Health sciences and finance and going from general purpose and this kind of pursuit of AGI, that's super expensive. But I don't need AGI. I need financial GI, FGI. I don't need AGI. Or maybe I got the G right. Financial General, Artificial General, whatever. But you get the point. And so that's where the cutting edge is now in the application, because anybody now can kind of write. I don't even have to write it. My code assistant writes it. I just need my OpenAI key, and I plug that in, and then I tell it to, take these tokens, and this is what I want to go for in terms of it. And it's good, and we've upgraded a lot of our sentiment and textual analysis from the older technology, NLP and dictionary-based signals, to context-aware LLMs. That's the great leap forward, and that's a huge improvement in some of these signals. But that's kind of like where we were like 2 years ago, and where we're going is much more about specific domain and data extraction, if you will, or using that to fine tune the approaches for much better results within our particular problem.
Do you see a gatekeeping assistance here? So I worked on the retail side of credit. So like the data I have on my customers is like, it's locked in like a black box, right? There's no way anyone can access it. You have to have special legal formats you do to gather data. With AGI basically just stealing information across the web, right? Because anything that's public is going to be put into these. And even if it's private, they're probably still using some of this in some way, shape, or form. Do you see there's like an advantage now of firms essentially capturing data or private data and having some sort of edge in the sense that you have data that nobody else has and that you can't even mine those off? I mean, I think that's kind of like the next wave of LLMs converge to the average. So if everyone's doing the average, we're all converging to the 50-50 alpha. I win half the time, I lose half the time. Do you see that as kind of the big advantage to a scale? A lot of these big firms are kind of gathering insights and information across the board.
Absolutely, because part of the scale is the information that you gather as you interact with the market, right? And you interact and you trade. And so there's different players within this space that operate at different speeds. And so there's a variety of different approaches being taken there. But the similarity is the availability and access to that data to help inform those approaches. And you have to have scale to do that. And again, it's kind of the opposite of like the two guys setting off from, Citigroup's prop trading desk and, setting up in Connecticut, their hedge fund, funded by their PBs, and they get all the back office and stuff. And there's a space for that too, but it's not going to be in this space because you don't just have the ability to have access to that data and scale that's required.
Do you see that, I guess, as a way of like a coming back full circle? So I know back like in the 70s, 80s, 90s, even early 2000s, banks were king. Like that was everyone wanted to end up in the quant space. It was like everyone wanted to end up at Goldman Sachs or Wells Fargo's divisions. And then we saw kind of a big hype cycle, which I think we're probably still in somewhat, where everyone wants to go to a hedge fund. But now it seems like a lot of the hedge funds are turning into a bank. Like it's a big behemoth with large scale, big teams, are no longer these small prop firms of 10 to 12 people. Do you think that's going to be kind of that market cycle as well, where we kind of come back to a I guess, bigger capacity and bigger skill set. I mean, getting smarter people. I mean, data engineers are one of those things everyone kind of like skips over, like, yeah, data engineers. But they're often like a key part to getting all the pieces together. Do you think it's going to kind of go back to that scale is going to be king, or do you think we'll see a little bit of a rise with AI in smaller firms?
So I think there's room for both in this kind of concept of where is the industry going. First, it's not that it's going to scale. Scale is already here. Scale is the story, and the GFC and the post GFC Volcker rule and a lot of things just kind of fundamentally broke the back of banks as the center of this universe and shifted it to hedge funds and then newer players that are in both sides of that business. So you think about Citadels and Jane Streets of the world, and so that's already happening and that's already drawing in a lot of talent. I think the other kind of interesting space though is this kind of convergence, especially in the AI space, the convergence between kind of AI and AI-centric, technology-centric cultures with financial-centric cultures. And you have some mixing of those because a lot of the problems that are being solved are basically dealing with the same skill set, right? So obviously, the story is DeepSeek and, where did it come out of? It came out of a hedge fund and you have other examples of that. And I think that creates, a different pathway for people with different skill sets that are both interested in the technology side, but interested in applying their technology skills to the financial problem. And it is a different problem. It's a really cool problem. It's a problem I've always been fascinated by, but it's an adversarial problem in a way that is, somewhat. There are examples where it's similar. There are examples where it's different when you're dealing with financial markets. And yeah, I think it's going to continue because it has such high financial rewards. Very high financial rewards, if we see what's going on in the AI space. So they kind of pale in comparison to, what you're seeing on the AI side, but they're still quite high, and so it attracts a lot of folks. And I think that's the other area besides the scale players that is developing.
Okay, that makes sense. What is the difference like when you guys have different products, right? Because you're not just doing like one portfolio like a hedge fund. You guys have mutual funds, you have institutional investors, you have ETFs. How does your systematic approach vary? Like, is the portfolio construction more focused on different metrics or risk kind of ratios that you're targeting for these different types of products?
Yeah, so let's bring it back to a little bit more of the day-to-day in my world. And to answer your question, it's really about identifying and then optimizing for that objective, right? So you're creating different objectives and different constraints associated with it. And then in the systematic framing, it's really about tuning the models for the attainment of those objectives. So I'll talk about a couple of different examples. So we recently launched a systematic trend strategy, but we launched it. It's called ISMF. Sorry for the shameless plug. And our objective was very simple there. We wanted to provide a trend-like experience that people were, familiar. It's a systematic strategy. It's one of the branches of the tree of systematic. It's a very different branch than Grenell Kahn and a lot of other things that we do, but we do that as well, and we have done it for a very long time. So we took that skill and we paired it with our incredible skill in running ETFs out of BlackRock iShares. But we wanted to give people, a very expected experience. So we've done a lot of second and third generation approaches to trend that we think improve the alpha, improve that IR, but change a little bit of the profile of the returns relative to a more typical trend. And we made a design choice. We were like, no, this product, we want it to be competitive within the trend world and give a more trend-like experience. The CTA smile. You're seeing it on the upside right now. So the returns are really quite strong on the upside. But you also expect in significant downward markets, downward trending markets, that's really where kind of the CTA market gets a lot of its assets and intention is it's a very counter-cyclical, it's a negatively correlated approach when you have those significant trends. So that's one way in which we built that model. And I'll give you a couple of other examples. We've run a fund for over a decade called BlackRock Systematic Multi-Strategy Fund. This fund, the objective was, let's build an alternative to fixed income. Let's use our technology, our alpha, particularly a strategy that we built out of our hedge fund experience, which we call defensive alpha. Kind of looks like a long put option on equity exposures, but it's not built with directionality or put options, but it gives you another source of equity diversification. So you think about like bonds in portfolios, they're there for the negative correlation. Bonds are expected to deliver to equities. We go through 2022 and that goes away because unexpected inflation destroys negative stock bond correlation, and the value of having a stream of alternative diversification becomes really valuable. But we framed the construction of that portfolio in the context of let's make it look and feel like a fixed income experience. So how do you define that? Well, fixed income volatility is around 4%. It has this degree of income associated with it. It has this degree of expected negative correlation. And so we build the strategies and build the portfolio from those strategies to sort of attain those types of objectives. So that was Systematic Multi-Strategy Fund. And last one, just to talk about, we just recently launched iShares Systematic Alternatives Active ETF, IALT, IALT, which is designed to be an alpha generator, liquid alternative, very low correlations to stocks, bonds, but higher octane in terms of its expected returns relative to, say, systematic multi-strategy. So relative to systematic multi-strategy, where that was more fixed income, lower risk return, more defensive, IALT, more higher expected returns, use it in the portfolio, substitute from equities. So you build the risk budgets so that you have more risk taken in volatility space, in an alpha space, to deliver a higher level of return. And so you build the pieces around, and what are you building them around? You're building around the centerpiece of a systematic investment process, which is an optimizer. So the optimizer is taking in inputs like forecasted returns, and is taking in objectives like expected returns and constraints like volatilities, correlations, factor exposures, and go back to the part of the conversation where I said, the centricity of the decision making. In a fundamental process, it's discretionary. In a systematic process, it's model. That's what it means to be in the model. The optimizer and the inputs and how you guide the optimizer in the process to deliver those outcomes, that's the systematic process. And that's part of my job as well, portfolio manager, making sure that that's been guided to the right levels. And then once that's running, making sure it knows what it's supposed to know. And then my job is to know what it doesn't know. Is there some outside risk here, like a global pandemic that we haven't seen since 1913? Maybe the models don't know the impact of that global pandemic. And so the models are going to make decisions, and then we're going to review those decisions and make sure that those are right. So building up different products around those different objectives and constraints, kind of understanding what the models know and what they don't know, that's kind of the systematic process.
Awesome. That makes a lot of sense. For one last question here on the podcast, what book would you recommend? It can be either just a generic life book, like a book you've enjoyed reading that's come back to you over and over. It could be a textbook, a finance book. Is there any specific book that comes to your mind as just one of your favorite books for the listeners?
Well, I mean, I've already mentioned the key book for systematically interested people is Richard Grenold and Ron Kahn's seminal textbook, Active Portfolio Management. So that one is kind of really key. And then, in my other, part of what I do is kind of being in the middle of financial markets and quantitative approaches. So active portfolio management, that's more of the quantitative approaches, but it's also understanding financial markets and understanding like how markets work. And there are a lot of great books that I've read around this one. We just had an announcement of a new Fed chair. Monetary policy is really quite critical. So there have been a lot of really good books written over the course on some of those macro topics. One of my favorites, though, goes back to an earlier history, which was the history of monetary policy during the Depression. It's called The Lords of Finance. It's really one of the most excellently researched and written books on the topic. It reads like a novel. It's really one of my all-time favorites.
Awesome. Jeff, it was great having you on. I appreciate it.
Great, Dimitri. Thanks for having the podcast for everybody, and thanks for having us on.
Jeff, it was great having you. Is there any last kind of insights, pitches where listeners can get more information on BlackRock and kind of their strategies and ideas?
Yeah, thanks for asking that question. We put out a lot of material. It's on BlackRock Systematic, BlackRock.com. I participate in a really nice piece. It's our firm-wide BlackRock fixed income outlook. You can find that on the BlackRock.com website. So a lot of different sources of material to follow up on some of our thoughts and publications.
Awesome. I'll link them in the description below. I really appreciate you coming on.
Great. Thanks for having us again, Dimitri.